Welcome everyone. This is Shane with Vested Interest. Wanted to touch base with you today, guys, and go over a portfolio update. Been a great week, at least for us dividend growth investors, value investors. I know a lot of investors are freaking out right now. The market has taken a dip here, has dropped back, pulled back, however you want to say it, whichever terminology you want to use. A lot of red out there. My portfolio is still up. I am a dividend growth value investor. I look for value, so a lot of the stocks that I have researched were undervalued when I picked them up and have grown over the last year. There are some that pulled back in this recent pullback as well. There always are in my portfolio, and those are the areas I look to add when those pullback occurs. It does a couple things, guys. It gives me a better dividend yield when those pullbacks occur, and it also gives me a higher return as those dividend stocks return to fair value or even at times above value. And we want to avoid overpaying for stocks. So even though stocks are in my portfolio, sometimes I will avoid adding to them. Even in my dollar cost average strategy, I do have a point where they are too overvalued and I won't add to the position. I do try to add a couple shares even to those that are starting to reach the overvalued state over time, because we can't time the market, but we can utilize time in the market to give us great returns. And if you've done your due diligence and researched the companies that you want to add to your portfolio, they are strong companies, growing yields. They're growing companies with great yields and great returns on capital invested. You should be fine over the long term. And if you don't want to utilize individual stocks for your portfolio, a lot of people like ETFs and index funds. So that would be a way as well. And even those have pulled back, and you'll see those pullbacks whenever the overall market pullbacks, because that's what an index fund and an ETF is. It's a large group of stocks, or in the case of index funds, it's big portions of the market, Dow 5 or the Dow, the S&P 500, the Nasdaq. Those are big sections of the overall market. So when there are pullbacks, like technology, the Nasdaq will pull back. S&P 500 is just the top 500 companies. So a lot of times those pullbacks will affect those index. But again, if that's your investing strategy, the best time to purchase into those indexes or ETFs are also during pullbacks, in my opinion. So let's get into the portfolio update. These are existing positions within the portfolio that have pulled back this week that I wanted to add to. Like I said, that will help decrease increase the dividend yield, as well as decrease my cost basis per share, and then increase my returns whenever these companies return to fair value or even above fair value. So let's get to it. So as you can see here, on January 21st, that was Friday, or was that Thursday? Thursday or Friday, I invested $617.75 into the portfolio. And with those funds, I picked up one share of Huntington Bank. Huntington Bank has pulled back as compared to the overall market, as well as where it sits in my portfolio position. So I just added the one share. Actually, I think it was the last one I bought, so I had about $15, $16 left, and I said, yeah, let's just grab one share of Huntington Bank. I may look to add additionally to this if it remains pulled back next week. We added 2 shares of Leggett & Platt. Leggett & Platt has pulled back again at $39. And let's just HBAN, let's jump back for a minute. Huntington Bank shares, ticker HBAN, is in the financial sector. We picked up one share for $15.46. We picked up 2 shares of Leggett & Platt, ticker LEG, $39.32 per share. Leggett & Platt is a consumer discretionary. I recently did a video on some other Best Buy, Foot Locker, and Whirlpool in the consumer discretionary. I think there's some value to be had here. I am watching this sector pretty heavily, and I probably will be adding some additional positions. Consumer discretionary is a area that I only have Leggett & Platt in right now, and I want to add some diversity within that sector. And this most recent pullback may be a time that I do that. So I'm watching a few others. Home Depot, Lowe's, Kroger is another one. Those 3. And like I said, I did a recent video. I think Best Buy, Whirlpool, and Foot Locker are already probably in buy territory, but I'm going to keep an eye on those. And if they continue to pull back, I will at some point pull the trigger on one, if not more than one of those positions. Let's get back to the update here. So we picked up 2 shares of LyondellBasell Industries, ticker LYB. This is in the materials sector. We picked up 2 shares of Realty Income, ticker O, $67.79. LYB was $95.28 per share. Realty Income $67.79 per share. We picked up 3 shares of Store Capital, ticker STOR, for $30.78. And Realty Income and Store are both in the REITs and real estate sector. They are REITs in the real estate sector, I should say. And we picked up 2 shares of Intel Corporation, ticker INTC, for $52.60. This is one that I had been adding to for a while. It got up to about $55, $56 per share, and I stopped adding to it. But now that it's dipped back down to the $52.60 per share, I wanted to grab a couple more shares, increase that position, kind of decrease the cost per share, as well as increase my yield. And again, if that is another one I'd like to, in the financial sector, or I'm sorry, in the technology sector, Intel is in the technology sector, that I would like to add to as well. So if this stays down, I may continue to add to it next week. And then let's just take a look at the overall portfolio. The total value is $75,284.39 as of the recording of this video. You're going to see this video on Sunday morning, so it will be as of Sunday morning. The markets are closed. It is the weekend. The dividend yield is creeping up, which is what we wanted. We want to hit a 5% or over this year, so we are focused when we see these pullbacks on increasing our dividend yield. So we want to find higher yielding companies as they pull back and add them to the portfolio to try to get this dividend yield above 5%. We are currently at 4.429%. And then, of course, guys, the most important part of the whole portfolio, the annual dividend income, $3,334.15. This will continue to increase and hopefully increase a little faster as these pullbacks happen. We want to add to the portfolio significantly. These may be times where we add additional funds when we see these pullbacks to increase this annual dividend income as well as the dividend yield. And then a quick run through the sector weights. Communication sector currently at 9.39%. Consumer discretionary 2.32%. Consumer staples is the second largest position. And there's a reason for that. Consumer staples is one, regardless of the market conditions, people are going to continue to buy food. They're continue to buy the things that they need, soap, stuff like that. So consumer staples are those items that people need on a daily basis. They can't really do without them. They'll go without stuff like in the consumer discretionary sector before they'll go without things in consumer staples. So that's always a position that will probably be towards the heavier weighted side for that reason. Good times, bad times, people are going to buy what they need for everyday living. The energy sector is another one. People need energy. You got to heat your houses. I live in Michigan, so energy is one that we're well aware of in the wintertime and the summertime. You want to keep your house warm in the winter and cool in the summer up here, so energy is a need for all of us. We like to have our lights on. Energy is currently at 11.66%. Financials, 8.99%. Healthcare is 12.84%. This is another one I don't mind having on the heavier side of the portfolio. We do have an aging population. As we enter into the baby boomers retiring and heading into old folks home, retirement homes, the healthcare costs, in my opinion, will continue to increase as our population ages. So that, along with the consumer staples, I think I will continue to remain heavy in the portfolio. Industrials at 10.79%. Technology is at 7.67%. This is one I might want to say, like Intel, for example. I might want to continue to add and bring this up a little bit. Material sector, I'm seeing a lot of value in this sector, or was for a while. Vail has started to rebound. It's up now 20%, but I was buying pretty heavy into Vail, SBSW, and Rio Tinto, all mining stocks there for a while. They have started to rebound. As the economy starts to decline, you typically see those mining stocks, gold, silver, other precious metals increase in value, because that's where people will tend to go to for safety in market declines. Along with the, like I said, the consumers, staple sector, energy sector. And then you've got utilities. along with energy, a lot of utilities, water, sewer, that sort of thing, natural gas. You need those, again, heat your house, take away your sewer and water to live. So utilities at 6.95%, REITs and real estate at 11.02%. And then we do not have any ETFs currently, but as I've mentioned before, I am looking at some emerging market ETFs, maybe some China, focused in China and India ETFs as well. I'm still doing a bit of research on those to see how they perform over time. And I don't know much about the emerging markets or foreign markets sector. So that's one area I think I might go the ETF route whenever I decide to pull the trigger and jump into there. I know they're down right now, but I also know there may be some issues with their financial situation, especially in China. Big developer going bankrupt, or looks like they're going to go bankrupt, so that may impact their economy or overall investing strategy there. But I do see some value in that sector. Ray Dalio is one that I follow. His overall portfolio and his recent 13Fs, he had gone pretty heavy significantly into emerging markets, foreign markets. So I was looking at some of the things that he bought. That may be something you want to do as well. I do look at Warren Buffett. So Berkshire Hathaway, it's Warren Buffett's, and you can look up Berkshire Hathaway 13Fs or Ray Dalio's 13Fs and see what those guys are investing in. They're much smarter than I am, so maybe get some ideas from what they're doing during these turbulent times. And guys, I appreciate you stopping by, checking out the video. Thanks for watching. Don't forget to subscribe if you enjoyed the video, see any value in the video. Hit that thumbs up, drop a comment, let me know what you think, and consider subscribing to the channel. It helps me out. Ring that notification bell so you can be notified whenever I do any future videos. That's actually a picture I snapped this morning out my back window. As you can see, the lake's frozen over out back. Pretty nice day. It's sun was shining, but don't let it fool you. It is actually snowing here now, and it's pretty cold up here in Michigan. So again, appreciate you guys stopping by. Thanks for checking out the video. Let me know what you think. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, we'll see you next time. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you are not comfortable losing. Always do your own research and invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.